You're watching IGTV and the IG Commodity Chat, where we put your questions to the experts. Today the focus is on black gold, and coming up over the next half hour. Just how low can oil prices go? Down over 30% in just 5 weeks. Prospering at low oil prices, we look at the companies best placed to benefit from the decline. And North Sea outage, G20 meetings, which way will OPEC go when it meets next week? And joining us to answer those questions are Malcolm Graham-Wood. He has over 30 years of experience in the oil and gas sector and has worked for a variety of leading companies within the industry, and did more recently, Malcolm taken on an advisory role working with companies such as HSBC and of course writing the acclaimed malkiesblog.com. Also with us we've got Spencer Welch. He's the Director of Oil Markets, Downstream and Energy at IHS Markit. Now Spencer previously worked for BP for 13 years, giving a wealth of experience in refinery process engineering and production planning. Welcome to the both of you. Thanks very much for coming in. Now, as I said, our guests are here to help you understand these markets, trade these markets, and indeed answer your questions. So to send your question, well, it's quite simple really. Send it via Twitter using the hashtag IGCommodityChat, and we'll put them to our guests, or you can add them to the IG community. They'll come straight to me and I'll put them to our guests. We've already had a host of questions in already, which we will get to in just a moment. But while you're thinking up those intriguing questions and for our guests, let's take a quick look into the history of crude oil.
The oil industry really began in the US in the 19th century as the period of rapid industrialization took hold. The new materials being produced meant that pioneers could explore for and begin pumping oil from places that had previously lain untapped. Within a year of the oil discovery at Spindletop in 1901 in the state of Texas, there were no less than 1,500 oil companies registered, which began the real growth in the US oil industry. US oil companies then began looking overseas. First it was to Venezuela in 1910. Historical documents had pointed to the Spanish incomers in the 16th century, utilizing bitumen as a sealant. Then in 1933 came the first contract to drill for oil in Saudi Arabia, after evidence of oil seeping from the sands in the region. Then, apart from a brief hiatus during the Second World War, new areas were being discovered as companies began experimenting with offshore drilling platforms. As a consequence of oversupply, prices began to drop, and as prices fell, the expensive process of investment on long-term exploration projects were put under strain. By 1960, feeling the need to steer control of oil production to maintain prices, an agreement between 14 oil-producing nations was made to control supply. OPEC, the Organization of Oil-Producing Countries, was then formed. The US and Russia, among a number of other notable oil-producing countries such as Norway, Mexico and Canada, were not signatories, but nonetheless controlled output to maintain stable pricing. The oil crisis in 1973 showed just how powerful OPEC was, with its dominance of membership by Arab countries. With the US supporting Israel in the so-called Yom Kippur War, the Arabian producers proclaimed an embargo of oil exports, and as a consequence, prices rose over 400% between October 73 and March the following year. A second oil crisis during the Iranian Revolution in 1979 developed, which was then followed by a 20-year bear market. Most recently, new technologies have aided a new oil boom through the use of hydraulic fracturing oil-based shale structures, although this is a more expensive delivery system and is unlikely to come to the fore until conventional oil resources start to run dry.
Okay, let's get straight to our guests now. We'll look at OPEC there, and I have to suppose one of the first questions then has to be, does OPEC still have the power that it used to, do you feel?
Well, it's got the ability to. I mean, in my view, it still controls the marginal barrel, and the marginal barrel, even though OPEC in itself doesn't produce any more than say 40% of the world's oil demand, still has the size of reserves to be able to either stop producing altogether and therefore push the price up. If it did that, the price would go through the roof. Or the ability to do what they tried to do a few years ago, which was to flood the market and go for market share. And that doesn't work because you've got markets like in the United States, where they're going to pretty much produce for cash whatever the price is.
Yeah, one of the questions that have come in already, sorry Spencer, it's on the same question, so it's fine, is, has OPEC lost the authority? If so, what is the new sort of dominant player, if there is one?
Well, I would agree with what Malcolm said. But they're less significant than they were. They're still significant, but they're less significant than they were. Certainly when they were formed in the 60s and 70s, I think really their influence has decreased with, as your intro said, with the surge of shale oil production from the United States, and all of a sudden that's kind of turned the market on its head and made OPEC maybe wake up a little bit more and think, okay, what do we need to do, because they're not as influencing as they were, and that's certainly been seen over the last 2 months with what's just happened with the price.
Let's focus on the price then, because we have seen, it just fall, and a lot of people are likening it to 2008. What would you liken it to in terms of what it means going forward?
I think it's unusual. It's hard to compare it with any one particular period in the past. I think it's a number of factors, almost like a perfect storm has hit the oil market. End of September up to the 3rd of October, price was at 86 and rising. Bull market, people were saying it's just a matter of time before $100 is hit. So the global economy was looking good, oil demand was growing, US production had kind of stalled, and the US was very, appeared to be going after Iran very aggressively in terms of cutting their exports down to zero. And literally, in a matter of weeks or less, all of those factors have changed. The US has issued waivers. Global economy has had a few concerns. US production has kicked on back up again, and that's the cause as to what's just happened. So a real transformation in a number of key factors.
Not everyone went for $100, although I was much more bearish than most, although there were plenty of people out there going for $100 for all the reasons that we just talked about. The point is that actually the first week in November was the real interesting point, because that was the weekend that the sanctions on Iran were due to come in. And actually what had happened was, well before that, in what is traditionally the tightest quarter of the year, the Russians and the Saudis in particular had jacked up production. And we now know that the Saudis, who have been producing, or for export, $10 million barrels a day, were producing over 11, and the Russians have gone up to 11.4 or 5. And so when the waivers came in and they were bigger than expected, just as you said, the market came down.
But I think what they were doing is basically, what had kind of been agreed amongst when OPEC met in June. They released the constraints that they'd self-imposed, and so Russia and Saudi were almost doing what they'd been encouraged or what they'd agreed amongst themselves to do.
And one thing else, just to say that, is that we talk about OPEC, but we should now be talking about OPEC Plus.
Yeah. Is OPEC Plus still relevant?
Only in the sense that the Russians and the Saudis, who've had this energy alliance since the agreement in October 2016, that continues, and we'll discuss this later, obviously. But if that energy alliance doesn't continue, then OPEC on its own is a weaker game than OPEC Plus.
I mean, it's all interlinked, and a lot of the questions kind of all over the place in terms of if we're taking OPEC meeting and G20 out of the equation for the time being, what is the fair price for oil at the moment is one of the questions that's been coming in. Where do you see it? What do you see as a fair price?
I think somewhere in between, the high of 86 that we hit and the low of just below 60. So somewhere close to 70 is probably the right price. So both the high point was an overreaction on the market about worrying about getting too tight, and this has also been an overcorrection on the downside. I mean,
Russia says it's happy with 60.
Yeah, and they did. They said that before as well. But when it turned out that they could get from 50.5, 55 to 80 with their production. I mean, the bottom line is that the agreement from October 16, which was ratified by the November 16 meeting in Vienna, was one that said, we worked out that going for market share doesn't work, and therefore, if we cut back by 10% only, we'll increase our monthly checks by 25%. And even Russia worked that one out. Now, at the moment, it's always the case ahead of an OPEC Plus meeting or an OPEC meeting that it's all about politics. And at the moment, you've got this terrible sort of political dilemma, and there always is one. It's just a question of what it is. And at the moment, I think you've got a problem in the sense that you don't know where Putin is standing, because he'll go straight from the G20 meeting to Vienna for the OPEC meeting. But Is he trying to rub salt in the wound that is the US of A, in the sense that where is he going to fall? And is he going to fall on the Saudi side? And bear in mind that the Saudis have got this terrible problem at the moment because that they want well more than 60. MBS, as he's called, has got this great plan which really needs 70 plus at least. On the other hand, after the Khashoggi incident, it looks like Trump has bailed him out a bit by saying we're good friends of the Saudis, and the unwritten word after that is that they should be good friends to us.
Well, I mean, as you say, Trump just recently tweeting his thanks to Saudi and basically saying, but we want to keep prices low. You've got Saudi saying we're prepared to do whatever it takes as long as it's everyone doing it. And Trump saying, well done, Saudi, but we'd like to keep prices low. I mean, he doesn't have, to a certain extent, the influence to change production, but at the same time, he has that political influence. How much is that playing into decision-making at the moment when you've got Russia and you've got Saudi and you've got so much else going on behind the oil scene?
I think it's hard to say, but so that makes the next meeting particularly interesting because you're absolutely right. So Trump doesn't want them to do anything. He doesn't want them to react, although they've strongly hinted at the meeting on the 11th of November that they're willing to cut production. That's not what Trump wants. So any cutting of production kind of puts a little bit of tension in the US-Saudi relationship.
But
this is the point. I think there's so many buts because there's so many
what
parts.
I must add there is what they say and what they do are two completely different things. Now, we will expect on the 6th of December a decision to come out of OPEC. They hate having long meetings. They hate having anything which is considered to be any sort of argument. I think what they'll come out with, in the sense, is that they'll say, we're going to cut production modestly. We think that the oil prices are a bit right, maybe a little bit on the low side, and they'll cut much more than they say they're going to.
So how much? I mean, you're saying 1.4 million is what's been touted. I mean, do you think?
I wouldn't be surprised if they didn't say they were going to cut by 1 million or 1.1, but I reckon that they will have been cutting by up to 1.5 million barrels a day already. And I think that's part, and then they'll better look at it, because don't forget, the first quarter and the second quarter is a big oversupply time, and therefore I reckon that we've talked about 0.5, 1 million, 1.4 million, which the Saudis are saying they're already cut back by 1 million, which they should do. I reckon if they only cut back by 1.4 million, that doesn't take away the excess of inventory in the marketplace. It will if they do it all the way through the next 6 months. But their plan is always to be there and thereabouts, slightly below 5-year average inventory levels. And in the last few months, we've seen inventory levels, particularly in the States, go up quite sharply. And so it's several percentage points above that now. So they won't want that. Are
you in agreement with that?
Some of what's happened is normal. It's the normal annual cycle. This time of year, refineries do their maintenance work, or some of them do. The weather gets worse in the northern hemisphere, so people drive less. So what's happening right now in terms of inventories going up, it is quite typical. But obviously, that is that in combination with other factors. Do you think that Russia's going to cut as well, but to spite Trump?
I think they will, and I think that the interesting thing is that you have got a sort of demand hole to fill up, because obviously all three of the reporting agencies produce monthlies, but the most important one was halfway through last year. OPEC, when they did their report about international oil demand, put the 100 million barrels a day thing as being by the end of this quarter. They've now pushed that back to third quarter of next year, so third quarter of 19. So that there is a gap, which I think that they will, I think the Russians will cut back, but particularly they may not say they're going to.
Do you think, though, this will all have been decided by the actual OPEC meeting next week? We've got G20 at the week, both of you nodding. Will it be decided? Will that just be a formality, do you feel?
There's an awful lot of pre-work that goes on, even in the days immediately prior. So the actual meeting, as Malcolm said, typically very short, because everyone knows what's going to happen. My personal view is I don't think they'll cut by 1.4. I don't think they need to, but I think there will be some cut.
So what does that then? Okay, 1.4, whatever. What do you think we're seeing in the oil price then over the next week, 2 weeks, 3 weeks? Where are we?
My guess is that we'll see a small bounce from these sort of levels. I think that I don't think that the Russians or the Saudis want to, to come away from G20 and the oil meeting and saying, we've cut back dramatically and then the oil price picks up. I think the oil price will pick up a bit. I think it's at the bottom end of a current trading range. And unless anything, disastrous happens and they say we're not going to cut at all or whatever, and which will be proved over the next few weeks when we see the actual numbers coming through into the market. But there are plenty of countries within OPEC who are unable to do anything one way or the other, and Iran and Venezuela aren't able to increase their production. We've got Nigeria who are outside the quotas, Libya who are producing like crazy at the moment, over 500,000 barrels a day. Angola aren't going to change their view on that. And of course the one other thing is that we've got this China-USA trade dilemma, which some people keep telling me that that they're about to cut a deal and that Trump is about to do a deal which will sort everything out. If it doesn't happen, the really interesting thing is that China was a huge buyer of Iranian crude, and Russia have been filling that gap in order to try and make themselves into the new best friend of China, and therefore that axis that they've been developing the last 2 or 3 years.
I think that's the problem with the oil market at the moment. There's so many pieces going on that actually the point at which they come together and properly fit together at the moment seems to be a long way off, and I think that's some of the uncertainty within that market as well. Not just the supply issues, demand issues, is that uncertainty about how everything fits together in the end.
I guess the market needs to see some positive piece of information, a positive piece of data to confirm effectively that the price has gone as low as it needs to go. So, stocks stopping to build in the US, production stopping to rise, some sort of trade or reduction in the escalation of the trade war. The market needs to see something positive to stop the slide.
We spoke to another guest a little bit earlier, Brock Silvers, Managing Director at KN Capital, to get insight into who owns the oil price because of all the topics we've been discussing. Let's hear from him now.
Well, we've seen some real volatility in oil markets, sort of almost head-spinning volatility, but we do have some moderating factors that we can see on the horizon now, both short-term and medium-term. In the short term, we have U.S.-Saudi political issues revolving around allegations of criminality with the Crown Prince that it looks like Donald Trump has elected to overlook. And it seems like the price for that forbearance is Saudi assistance in controlling oil prices in the near term. That will be good for the U.S. economy. In the medium term, look, this becomes a U.S. fracking issue, and fracking has revolutionized the sector. The frackers are profitable at current pricing. The real constraint is in distribution. We have significant Permian pipeline capacity coming online throughout 2019 that will continue to shift pricing power to U.S. producers. That will also be very good over the medium term.
Okay, one of the questions that kind of follows on from that has been sent through. Don't forget, you can send your questions through using the hashtag IG Commodity Chat to send it on Twitter or indeed on the IG community as well. To what degree will Saudi Arabia's decision be influenced by the fear of upsetting Trump?
I think it'll be they'll want to be seen not to be upsetting Trump, but I don't think they care one way or the other. They really genuinely want that oil price to be a bit higher, which is why I say that they will probably cut back production probably a bit more than they say they're going to. And what they say and what they do are two completely different things, because I think they will cut production and they will say that they're doing all they can to help out the sort of US economy. But on the US economy, and probably more for other people to comment, one of the things is that we've had a constant strong dollar. You talked a few minutes ago about, when I mentioned China, about the fact that's another influence on the oil price. But actually the strength of the dollar and the fact that the Fed have been saying consistently through this year they're going to put through more rate rises because the US market is overheating. The strong dollar absolutely kills emerging markets who are using their own weak currencies to buy dollars in order to pay for oil. And we're talking about the three biggest currencies there are the euro, the rupee, and the yen, all of whom, which, you know, the Brent price actually is only down 9% on the year or so this year, but for those three countries, the oil price is up still on the year. And, you know, the irony is that Russia, whose currency is underperformed by 20% because of its oil production, is actually, you know, seeing a higher price on the year already.
I want to move on to kind of the beneficiaries in terms of what we're seeing in the oil price, but because we've got quite a few questions on OPEC, I'm going to run through a couple of them quite quickly, if that's all right. So we've got how are OPEC allowed to continue to function as a cartel when in any other industry it would be illegal? It's quite an interesting one to look at, that one.
I guess it's not governed by laws. It's country policy. So they're allowed to adjust their production as they see fit.
How low can oil go, and we've kind of addressed that. How long can the primary oil producing countries continue to pump below their production cost per barrel?
Well, I see it as being two different things there, and this falls into the Saudis' hands to a certain extent because it's production costs. And actually, there are a lot of countries that will produce way below the overall cost of production, but whatever it costs to produce, i.e. they're going to run it for cash. So actually, the US is a bad example of this because, you know, especially with the debt that the US companies have taken on over the last few years, their break-even price is pretty high. A lot of people say that, you know, in the Permian and the Eagle Ford and so on, you wouldn't be able to pay, you know, you wouldn't be able to take less than $40 a barrel, but much lower than that if you run it for cash. So I don't know whether you agree with that. So.
I do, but you know, even though the price has dropped, it's still way above almost everybody in the world's operating costs. So they'll keep on producing for, you know, even if the price was to carry on dropping another $10 or $20. The issue is about finding new oil, and that's more of a medium and longer term issue rather than a short term issue.
And on that point, it's worth saying that the companies wise, since 2014 when the oil price fell, did two things. First of all, they cut capex back in a big way, which is what you were alluding to, which meant that so for production which is due to come on stream in 2022, 2023, it's not going to come on stream at least until a bit later because of those production cuts. And secondly, the oil industry cut back their costs in a massive way. I mean, I would say that most oil companies since 2014 have cut costs by 75%, probably, certainly more than 50%. And that means that, you know, they don't go ahead with deals that don't make money at much more than $40, certainly no more than $50. So, you know, they are at $60, $65, still making good money on pretty much everything they do.
A couple of the questions regarding OPEC. I mentioned it earlier. Saudi has said they're willing to do whatever, but not alone. How much support do they have?
They have a reasonable level of support. So Kuwait and the United Arab Emirates, they typically do what Saudi Arabia does. They all, when they first put the cuts into place in 2017, they were following suit. Iraq doesn't tend to, or is a little bit looser with its implementation of plans. The others, Venezuela, Iran, as Malcolm said, they have little influence in terms of their production. Libya and Nigeria is pretty volatile. It's hard to know what's going to be happening in a month's time.
It's kind of a long question here. This one it's come through on Twitter. OPEC are now being much more careful about communicating the price targets they're working to so as not to fall afoul of US law. Mr. Neeson on Twitter says, in a recent interview I heard the current president of OPEC allude that there are target equals the 5-year average price. Do you agree? And what is that price? Is it around $64 per Brent? Did you follow that question?
Roughly. I mean, I have to say that, you know, you're hitting a sort of fairly moving target there. But I would say that each OPEC country has a different target in the sense, as I talked about, MBS's current plan for Saudi Arabia for the longer term. You know, I think his target is minimum of $75 a barrel. It's not going to get there, and you have to be pragmatic about what that happens. But there are various parts of OPEC which still don't make money at $100 a barrel. So I think that the idea that there's a sort of target for every country, let alone OPEC in general, as to what the oil price is, in general terms, I would say they weren't in favour of the oil price when it was 85 or more, because they know, particularly because I talked about with the strong dollar, that demand really does fall off at that level. And it might be worth hearing the comment on the on the downstream side of it, because that's where it hits most of all. So I would say that the target price is, as you said, somewhere in the 70s, but if it goes above 80, it takes demand away, the downstream.
It does, but oil demand is relatively inelastic at the moment. So people have their cars, and there's not much alternative fuel. You can't go and fill up on something else. So what you can do is you can drive a little bit less. So right at the moment, the price has to go up significantly before it really has an impact on demand. And generally, refineries are reasonably well insulated from that. So what matters to refineries is the difference between product prices and crude price. If crude price goes up, as long as product prices are responding, then they're generally okay. The price changes have a much more significant short-term impact on the producers.
Interesting you mentioned cars. One of the questions is, will electric cars have an effect on oil prices? We knew this. If so, how much, and when are we like to see it actually come through? I suppose when we see more electric cars on the road.
Not for 20 years.
Yeah.
No, because if you look at all the long-term forecasts, they say that however many electric cars you see in this country and the States and so on, it doesn't even touch the sides, because even in the UK, a sophisticated market, you can hardly drive from London to Birmingham without needing to fill up. Taxi drivers with electric cabs can only last for 3 hours in a cab, and sometimes it takes 50 minutes to top up on electricity. This ain't going to happen. You can imagine what's going to happen in a continent like America. They drive 400 billion miles every month, and the average age of a car in the States is 17 years old. That's not going to change anything. Africa's not going to change. Yeah, sure, electric cars are going to come in. They're going to have tax efficiency and everything else. But
it's going to be a long, long time to
But it will come, and it will revolutionise oil demand. But what people don't necessarily realise is that in the short term, over the next 10 years, improving vehicle efficiency is about 8 times as significant for oil demand in terms of reducing it than the switch to alternative fuels.
Let's move to more the investing in oil and how we should be doing that at the moment. I know we briefly touched on companies, we touched on where the oil's coming from, the drilling, we touched on downstream, upstream. So let's give an overall picture at the moment in terms of who the beneficiaries are of what we're seeing in the oil market at the moment.
Well, it depends what you mean by at the moment, because obviously this year we've had a rise from 60 to 86 and then a drop from 86 back to 60. So the upstream producers in the main were happy about the rise to 86, and the producers have suffered. Probably if you take the annual average, it's above 60. So it's been a reasonably good year, certainly better than 2015, 16 and 17 in terms of the average oil price.
And I think, I couldn't agree more. And I think that if you'd said to somebody in January or February the oil price would be $65 in November, they'd have said absolutely fine. And given that I said, we're unchanged to a bit up on the year. This is what the oil market is made of. Massive changes, and as far as I'm concerned, in terms of the investing, the worst thing that's happened is that the fact the oil price has come off the top has meant that we might be 30% off the top in the oil price, but oil companies are 50% off the top, and what's happening is we're starting to see M&A activity in the sector, because oil companies with cash and having done things are suddenly thinking, right, we can go out and buy the high quality stocks with the really good managements who've done well and have now been marked down by the market. And as I've always said, is that oil is now cheaper to buy on Wall Street and the London market than it is to go out and drill for it yourself, which is what DNO have done by bidding for Pharaoh, for example.
Yeah, I mean, this is the interesting thing in terms of, you say, depending where the price are, you go back a couple of months, they would be happy. As an investor at the moment, upstream, downstream, are we looking at the big players, the small players? We're seeing dividends go up on energy stocks at the moment. I mean, what should I be looking? Where should I be looking?
Well, I'll let you talk about the downstream side, but I mean, but to a certain extent, you know, the first half of the year was fantastic for the majors in the upstream area. You saw the results that Shell and BP and all of them were coming in with, and they're making money hand over fist. And their ability to do that means that they can pay dividends, which meant that, you know, it wasn't very long ago these guys were yielding 8%. It's 6% now, but it's still, you know, given what yield is available on the street, that's still pretty impressive in terms of what they're able to produce. And of course, in the second half of the year, with the oil price coming down, I suspect the downstream market is, I should think refining margins and things like that are looking pretty hot at the moment, aren't they?
Well,
or should be.
You're right, though. So when crude price is dropping, there tends to be a lag in the reaction to product prices. So for a short time, refineries are doing quite well. But actually, the gasoline market has been very, very weak through the autumn period, and so refining margins have actually been surprisingly low. They have picked up recently, but it has been a more challenging recent period. But in terms of oil refineries, things are actually pretty good for the last couple of years. They went through a really rough patch, 2009 through to 2014. The last 4 years has been pretty reasonable refining margins, and we expect that to continue through to 2020.
Because they've taken capacity, they've just taken a lot of capacity out.
Yeah, and so in those real tough 5 years in Europe, 2 million barrels per day of refinery capacity shut. So it's a more efficient business that's left.
There was a question on refineries that's come in from the IG community. Thanks very much. What point do refineries start to dump oil products onto the market in a panic? What are the chances we'll see the same weekly DOE data as in Q1 of 2016?
Refineries don't dump in a panic. You know, they have relatively limited stocks. They're just keeping themselves going. So they can't afford to play games with oil inventories. Some trading companies can, and there's more spare capacity there, but not the pure refinery.
I've got a question about your bucket list, Malky. Of course, here on IG, we keep up to date with Malky's bucket list. It says, what's your top bucket list stock?
Well, I mean, yeah, I don't know whether you're asking which is the best performer so far this year.
I'm not asking. This is from Mark. Thank you very much, Mark. What is your top bucket list stock?
Well, the one that's probably creating most excitement at the moment is probably Hurricane Energy, because when I did the last calculation about a month ago, Hurricane were the best performer of the year. And ironically, because the first half of next year is going to be the most interesting time for Hurricane, because they have got this Lancaster development. The FPSO is en route already. Should be by the end of December, in my view, should be tied in and getting ready to produce. The market will want to see for a few weeks to make sure it's producing. But if it does, all hell will be let loose, and so there's a massive amount of upside. But actually, we've got other stocks which have had a bad run, which are beginning to do well. Obviously, Ferro is probably now, if I'd read it now, would be way the best stock, but they've been bid for. And they've been bid for because the oil price came down, the shares came down from 170 down to 125, and there was a guy who held 28% of the stock, which he bought at 120, and thought, this has just fallen into my lap. One of the best companies in the marketplace has just fallen into my lap. Just shows quite how unsophisticated markets can be when this happens. But you've got other companies where, you know, investors should watch the management buying their shares, because the management, take Emergence, for example, you know, the board have been buying stock like crazy in the last week. They've done deals, they've cut things, and they're moving ahead. So, yeah, I mean, in the bucket list, you know, the bucket list is meant to be, you know, people never believe this because they say, you know, I've had a dry hole or something like that. The bucket list is meant to be a combination of stocks which will give you a bit of everything. A bit of the Ferro, where I'm absolutely convinced I knew there was going to be a bid coming along because the guy had bought 28%. Some more high-risk plays and some more low-risk plays. It's meant to be a balance. I know that never works because people always try and buy the sex and violence. But actually, you know, within the bucket list, you know, the ones you'd be looking at the moment would be Hurricane and Ferro, Emergence, and a number of others which have which show really good prospects at $65 oil.
Cool. One thing I haven't really touched on, but we are almost out of time, but there are a couple of questions on it, so I'm just going to kind of bring them into one, is shale. We touched on it, the impact of it, what we're seeing there, and how much that is impacting the oil price.
Well, it's hugely significant. So back in 2008, US production was at 5 million barrels per day. At the moment, they're at 11 million barrels per day. So it's quite incredible what has happened. And as the pre-recording said, they're going through a little bit of a slowdown. It's still increasing, but maybe not quite as fast because they're waiting for some pipelines to be built. That's acting as a bottleneck on getting the Permian oil out to the coast for export. We expect those pipelines to come online middle of 2019, and then there's going to be another surge. So the US production we expect to be heading up to 13 million barrels per day. So that, again, looking to the second half of 2019, oil price is likely to come under pressure again.
But longer term, no, I must say this, longer term, shale and American production is the inverse of what we're talking about with petrol and electric cars and everything else, because it takes 30,000 wells to produce in America what it produced you can do with about 50 wells in Saudi Arabia, and they cannot keep delivering this production. In 5 or so years' time, US production will be falling off a cliff because, you know, they've done everything they can. They've drilled every well, they've got everything going.
Of course, Spencer's shaking his head over. Come on, Spence.
We don't have the same forecast as you. We expect it to continue ramping up. They're very innovative in terms of their ability to maintain. They're getting better. The decline rates are not as fast as they were.
Agree with that.
I definitely don't see it falling off a cliff.
That's what we want to end on, differing views. Well, we wouldn't have a market if we didn't have differing views, would we? So thank you both very much for your time, for answering our questions. Thanks also to you for sending in your questions. And of course, you can continue with the discussion on the IG community thread as well, using the IG commodity chat thread. You can also send in more queries on Twitter as well, using the hashtag IG commodity chat. Our next show is this time next week. It's at 1 p.m. again, Thursday the 6th of December. A date in a diary for those oil followers as well. We're though going to be covering global trade of key base metals. They include copper, aluminium, zinc and nickel. My colleague Victoria Scola will be in discussion with our guests, including Daniel Akagi, author and economist, and also John Mayer, partner and mining analyst at SP Angel. We'll be streaming as usual, live across IG.com, YouTube, Twitter and also Facebook. So do join that debate as well. Thanks again for joining us and for sending in your questions. Have a great day.